Hi, I'm Greg Weldon. I'm your host for Money Markets and New Age Investing. This is Season 3, Episode 11. We'll get one more in at least before we go to Season 4. We roll over and Thanksgiving's our seasonality. But, it's really interesting here today as we kind of look back already a little bit on 2025. It's like, what? It's going to be the fourth quarter of 2025. How did that happen so quickly? And looking back, it's interesting to see some of the things we've said and to where we are now and how you have heard this narrative, especially on TV, where everyone has ratings go up when the stock market goes up for the financial channels. They bring on most of these guys are portfolio managers, they're money mutual fund managers, money managers. They all have skin in the game, but all in the same way that they're all bullish on stocks. So of course the narrative always is kind of biased towards being positive, and hey, that's fine. I mean, who doesn't want to be positive? But it kind of shades the reality. And we've talked this all year about the consumer. One of my 2025 year ahead, that's kind of what we're going to look at a little bit here today, was the consumer cocoon. And if it led to a credit contraction, that would be a big deal. It's happening right now. I also talked about, of course, housing's in crisis. We know that. We talked about the yield curve and how the bond market would start to shy away from all the supply we got to sell. We're pushing buyers away with tariffs, with sanctions, with our trade war. At the same time, leaving the Fed, again, as the buyer last resort down the road to make sure it's not a bond market crisis. So you throw in then the labor market, which everyone insisted was strong, and it made me kind of sick to see the data and to see the misleading use of headlines on financial television, even to the political side of television. And how if you were saying that the labor market was weak, you were rooting against Trump, quote unquote, from one of the Fox News personalities. It's like you can't tell the truth on either side now. I mean, you can't be critical of any single thing ever. Come on, man. I mean, it's gotten so bad on both sides, it makes it very difficult to navigate any of these political waters. But the bottom line is the facts are the facts, the numbers are the numbers, the math is the math. It's not in dispute. We have trashed the consumer side of this for months. We started trashing the labor market side 3 months ago. And all of a sudden, like everything happens these days, I've been doing this for over 40 years. And I've seen one repeating pattern. It's all around human nature, whether it's pain avoidance with debt, push it down the road, or whether it's the case of you don't really trade off of something until everyone sees it because you need the markets to move. And for everyone to see it, it has to be above ground. So if you're not digging underground into the data to find the details, the micro that starts changing before it gets to the macro level, and it rises above the earth so everyone can see it, as just happened with this week with the labor market data, not just from the BLS either, across the board labor market data. Now it's an epiphany. And now the markets are really moving, particularly in terms of the U.S. bond market. Well, if you recall, we were talking about starting to build a position, the 5-year Treasury note a couple weeks ago, at least last episode here. And that market's now breaking out. But let's get back to the data, because I'm going to go through this data really quickly, and it's a lot of it. So fasten up. Here we go. Challenger Gray Christmas. Great information. Doesn't usually matter. Suddenly it matters when you see layoffs at 86,000 in the month of August. Check that in the month for the month of August, excuse me. That's the 8th largest month of layoffs since the pandemic, most of which have come, recently. And it's the 15th highest single month of layoffs in the last decade, including the pandemic. Let me say that again. Over the last 11 years, going back to beginning of 2015, 2014, end of 14, you're talking about, 15 years. And you're talking about, this is check that 10 years, but this is the 15th highest single month number in layoffs through an entire period. Not only that, but the 8-month year to date through August is 892,000, which is larger than last year's full year total of 761. 892 versus 761 a year ago, full year, and you still have 3 months left this year. All right. Now, what's interesting here, to dig deep. The deeper you dig, the more you find, and the more data you have to put together your puzzle. Doge and AI have had an impact. AI, I calculated it out based on what the BLS data was to around 3.5% of jobs lost because of AI. Doge was more sizable. And what's interesting around here in terms of layoffs is that Doge was one of the biggest factors so far this year until August, and really until the last couple months. It's completely waned. All right, there's virtually no impact. There was zero impact, according to the BLS, from AI in terms of jobs lost in layoffs of 86,000. So the things you might say, or you will probably hear on TV for people that don't dig into the data, stuff, Doge and the AI impact and so on, so not at all in August. This was pure, the reasons cited, bankruptcies, plant closures, business failures, and cost cutting. Doesn't that sound like the R word to you? Bankruptcies, plant closures, business failures, and cost cutting. Layoffs in services are up 60% year over year. Services are looking really, really sickly. To continue, not only does Challenger Gray Christmas give us the layoffs, it gives us hiring plans. And in this case, less than 1,500 new hires in August. It's the lowest August ever. Not only that, at 1,500, and you're talking about tens of thousands normally in an August, and sometimes even six figures. You got less than 1,494. So in July, you had 3,200. In June, you had 3,200. All three of those months were the lowest in the history of this survey in terms of hiring. So this June to August summer period was the least amount of hiring, according to this survey, that we have seen, dating all the way back to the financial crisis. This data started in 2009. ADP, all right, ADP, 54,000 increase, but 40,000 were leisure and hospitality, which is the lowest paying industry of all. Well, it's number 2 behind retail, all right? But not only that, it's half of July's number, but not only that, when you take the April, August 5-month total, okay, job increase of 226,000 is the lowest in 5 years for any 5-month period. Any 5-month period. So when you talk about leisure and hospitality having literally 90% of the jobs that were created, according to ADP, only 4,000 ex-leisure and hospitality, you start to break down the pay. And ADP does a great job of monitoring the pay for job stayers and job leavers. It's a really kind of in-depth stuff. What you have is ADP pay for the average person staying at their job, 4.4 down from 4.5 a month ago, down from 7.8, which was the high in 2023, I think it was, or 22, one or the other, but 7.8 was the high. You're now down to 4.4. But here's the problem. Here's the problem. When you don't dig deep enough into the data. Let's consider small businesses, less than 20 employees, 1 to 19 employees of businesses that run as a business, not really including the family businesses that are not really operating at as a real balance sheet business. This is the way they break it down, all right? This is the ADP who gets all the payroll numbers, all right? So small businesses, less than 20 employees, 89% of the businesses, and representative of 47% of the workforce, almost 60 million people represented in the 1 to 19 number of employees category that ADP gives us data for, where the income growth there, the actual growth, not expected growth, the actual growth versus a 4.4 headline, which gets everyone all excited because everyone's making more money. No, half the people are at 2.5, which is below the core PCE at 2.8. They're minus 30 basis points in real income. By the time they cash their check, they're already underwater in terms of what their money can buy. So let's talk more about services, all right? Because the ISM service number was really interesting. I have to admit, there was strength here in the orders and in the activity. New orders and activity were strong. No denying it. The numbers in terms of the firms and the percentages flipped was robust. So that was a good part of this number. But the bigger part, and the thing that the people at the ISM highlighted, were that inventories are now rising for a couple of months in a row, and the backlogs have crashed. Backlog of order has completely collapsed. It's a 16-year low in the backlog of orders index. So what's happening? You've cleared out all the backlogs. That's kept production high. And now that's sitting on shelves. It's inventories. And by the way, I'll throw in here the LMI, the Logistic Managers Survey, the LMI, the Logistic Managers Index, just told us that warehouses are almost full, capacity's up, costs are running really high now, as is transportation on the downside, because now you're not transporting as much stuff because you have warehouses full of it. So inventory costs are rising, warehousing costs are rising, the capacity held at warehouses is rising, unwanted inventories in the ISM are rising because the backlogs have collapsed. This is set up to pancake the service economy. And we've already talked about, too, kind of the service economy. When you're talking about this whole 9 yards around these inventories versus backlogs, which is stagflation, because prices are still rising. But what's interesting in the PCE data, spending on services, which is 71% of the economy, was only $8 billion in July. That's a tiny, tiny number. That's 0.1%, which annualized, let's just call it 1.25. 1.2 annualized, and that's been running, it's been 0 or 0.1 for 6 months in a row. So it's actually even a little lower if you take a 6-month annualized. It's even lower than 1.2. And then we take the PCE Service Price Index, which rose to 3.6 from 3.5. You're talking about the service industry is in a stagflationary upside down situation of 2.4%. That's big. That's big. I mean, it really is, you know? So, among all of that, I thought this was really interesting as it related to that. When you're talking about that as well, I mean, 5 out of 6 months, the employment index from the ISM for services has been below 50. Been below 50. That's a rarity. 5 out of 6 months. It's really low. It's 46.5. 71% of the economy. You're talking about, the employment dynamic shrinking. We see the same thing. All the data now is starting to confirm all of this stuff. All right. Let's look at the PC numbers for a second, which came out a week ago. It's one of the last data points to come out for the previous month. So some people look at it as stale. I love it because it gives you such detailed numbers for so many different things. All right, you're talking about disposable income was up big. This again is like, wow, there's a positive. Holy mackerel, let's grab onto it. I want to be positive about something besides, just life in general and spirituality. But talking about the markets and the economy, the reality of what we do. 93 billion in DPI, most of which came from wages and salaries, but you also had returns on assets up, proprietary income up, rental income up. All of this was up. So 93 billion in DPI in a single month, it's this annualized increase over the entire total. So, which is looks at trillions over a year. You're talking about spending, though, rose by more. So the second they had money, they spent it on. Vehicles were a third of the expenditures. Vehicles. And you might say, well, that's a discretionary item. I would say, no. This is exactly what I know someone actually in my family who's, been waiting to make enough money to buy a car. And it's like, this is like a necessity for a lot of people. The second they have money, what do? Huge spending on vehicles. We saw it in the retail sales number, too. It held up retail sales almost single-handedly. But what's the same thing we see here is what we saw in the retail sales number. Besides vehicles, spending was on healthcare, food, and housing. What it wasn't on was eating and drinking establishments. In both the retail sales number and in the PCE numbers, deflation on a monthly basis. Now, for several months out of several months, in two of them, two data points coming from different places telling us the same exact data on the same exact sector. People are eating and drinking out less, and that's a feel-good factor, and that's a sign of the consumer cocoon's hardness right now. And what I say at the beginning of the year, consumer cocoon, and there you are. It's there. And that you'd have, if you turn into a credit crunch, that would be a real signal. And that's now happening. We're talking about commercial bank credit, consumer loans, credit cards. All right. As of May, this is weekly data, May 7th, 1.1 trillion. As of last week, 1.098 trillion. Check that, vice versa. 1.098 trillion on May 7th. Now 1.1 is literally only 2 billion higher on a $1 trillion number. 2 billion. Okay. That's 0.18. Annualized, that's 0.7. 0.7 increase in commercial bank credit card loans outstanding, 0.7 annualized, versus a year-over-year rate of inflation of 3, 3.1, 2.8. The year-over-year rate of credit card, I should say, the year-over-year rate of credit card growth in the same area, 0.7 annualized, but the actual year-over-year rate has dropped to 3%, which is below anything we ever saw prior to the pandemic. I mean, going all the way back to 2008. I mean, the low back then was like 4 and then 4.3. All right. You're talking about inflation, core CPI 3.1 against credit card spending, loan growth, commercial banks 3%. It's not even the rate of inflation. So it's not keeping up. Even though it's it's now starting to crunch in terms of people either can't or are unwilling to borrow more money at the highest interest rates ever. So, we talked then about turning to the Fed because all of this, especially the data we got, in terms of the, we're not even ready for the Fed yet. Where am I here? Yeah. So in the same vein, revolving credit is another one. That's consumer credit. All right. And revolving credit is one of the two categories. All right. It's down 34 billion over the last 12 months. It is a rolling 12-month negative for months running. It's the third deepest deficit ever in terms of, credit contraction. The only other credit contractions that were larger were 2009 and 2020. And now. And then you wonder why, seriously, delinquent on credit card debt is 12%, the second highest ever, second only behind 2008. Are we seeing this here? I mean, are we seeing it? Let's then talk about the consumer's expectations going forward, because that's even more critical. If the consumer's choking, if the consumer's cocooning, and you're in a situation now where they've run out of gas, what happens next as consumers see their real income plummeting in the next 12 months? The University of Michigan, you might chide at that, but University of Michigan survey, 3.9%. Okay? 3.9% for 5 years. That's unanchored. That's inflation expectation unanchored, no doubt. As is the 1 year, which jumped in August to 4.9, up from 4.5. That's 40 basis points in a single month. It's above 4 for 7 months in a row. So you're either 3.9 or 4.9 on the 1 year, 5 year inflation expectations for University of Michigan. Now, you may say University of Michigan is not really credible. I would tell you this. The New York Fed survey says the same thing, in the sense that the New York Fed shows the household survey 42.1% of households, consumers, the largest grouping ever in any one of these categories of the end result. 42% expect inflation 1 year from now to be above 4%. So it's the Fed, it's the University of Michigan. It's all telling us that this is they're expecting some of the highest inflation that most people have seen in their lifetimes. All right. And here's the rub. It's now affecting every income level now, because when you're talking about a 3.9 or a 4.9 rate of inflation, even the 100K and above income level who has an income expectation of 3% over the next 12 months is negative relative to inflation expectations 1 year out. Big time, by almost 2%. Below 50,000 in income, you're just getting crushed. It's almost a 4% negative real income deflation. How do you people keep on spending it? They don't have credit cards that's been taxed out. And now, oh my God, come on. And now labor work is going to roll over? The non-farm payrolls would show the following. Newly unemployed, 177,000. That's 5 weeks or less. Long-term unemployed, 27 weeks or longer, 104,000 increase. Part-time for economic reasons, up 65,000. Marginally attached, up 147,000. Discouraged workers, up 89,000. Not in the labor force, 2.86 million. Now that's down a little bit of interest from a month ago when it was 3.1, which is up there with 2009, 2014, remember you had a taper tantrum, and 2020. Talks about turbulence when you're up there, when consumers are not working, let alone, earning less than inflation. Come on, man. This is like, I'm laughing because it's so bad. You have to just kind of try and make light of it, even though you can't. And that's why you don't hear this on TV. All right. And here is another rub. All right. It's kind of rubbing your nose in it, right? Those that did return to the labor force, there was 220,000 of them. Okay, so labor force grew by a lot, 436 increase, including people getting of age and stuff like that. Then you had a rise of 148,000 in unemployment. That gives you a total increase, not necessarily in the labor force, but it's a pool of labor of 564,000 for the month, and only 288,000 of them found jobs. That is why the unemployment rate rose right there. Because for the first time, you had a dynamic where it wasn't more people dropping out of the labor force than finding jobs. And that's why the unemployment rate was not dropping. That's over. Okay, that's over, at least for now. So that all leads us to the Fed, not to jump ahead before. But the Fed, all right, so this was like an epiphany on Friday. It was like a wake-up call, like, oh my God, the labor market's weak too. Holy mackerel, the Fed's going to have to ease to support the consumer. I mean, we've been saying this for a couple of months at least. And we talked about at the beginning of the year, of course, one of our big plays was, first of all, consumer cocoon and potential credit crunch, which would then drive the Fed to acquiesce to higher rates of inflation. That's now coming. I mean, honestly, the Fed funds rate, they're going to be cutting rates when you haven't had the PCE core rate at or below target for 52 months. And you're going to tell me the 2% target is credible? They're abandoning it. They're just not telling you. All right. So the market is too, because frankly, inflation's going to rise, so they need to cut soon. Otherwise, they're going to be seeing even more acquiescing, and that could be even more dangerous to the bond market. So this is where people are already talking about yield curve control, because this is going to be a fine, walking over Niagara Falls with a bounce beam, So let's look at the Fed and where it's priced now, because not everyone follows this out there. Fed funds. So for the end of this year, currently 4.25 to 4.5 is the range, which means 437.5 is the actual midpoint. So keep in mind, 437.5. For the end of 2025, you're looking at 3.77, and by the end of next year, 2.89. So you're pricing in a 100% chance of 5 interest rate cuts to a minimum of 3% by the end of next year, and a 94% chance of a 6th cut that will get you to a level of 2.75 to 3% as your target range for Fed funds, with the midpoint therefore obviously of 2.875. So coming down from 4.375 to 2.875, that's 150 basis points in 15 months. That's a lot. Not only that, but the chances that we get 2 cuts this year is right now, according to the markets, 100%. But the chance that the 3rd cut comes this year instead of next year is actually 42%. That's pretty high. Now, I can make a case that you could easily do that and get to a range of 3.5 to 3.75. Why? Because now you're more than 50 basis points above the rate of inflation, which would be neutral. You need to be neutral at least. And then if inflation rises, then you're going to actually get a little more stimulative as inflation rises. I hate to say it, it's like by doing nothing. So this is where the Fed is already, we know they're behind the curve, and they may actually miss the boat here in terms of the timing to get to a level that might be a little more stimulative, that might say where the Fed funds pushes it down to below 3% for next year, where the real Fed funds rate is 0. Back to ZERP. This is what's priced into the market. This is what's priced into the market, is we go back to ZERP by the end of next year. What do you think stocks do if that becomes not a reality? I mean, holy mackerel. That's about as positive a monetary backdrop as you want to paint. Unless you think Donald Trump's going to get control of the Fed and force them to cut rates to 2%. That's not happening. It's just not happening. So within all that context, what's interesting too is we started building a position in the 5-year, which is more VIG than the 2-year. The 5-year, 2-year curve is flat. It's 5 basis points, been there for weeks. So the 5-year is moving with the 2-year, which is really interesting, because this is suggesting people are not worried about a bond market crisis, and they don't see an end to whatever QE is coming next until 2030. Think about that. This is how bad the market and the fixed income market is priced, and the stock market is priced for virtual nirvana. So we're long the 5-year note in a futures market. That's what we do, trade regulated futures contracts. And what's interesting, the 2-year note is 348. All right. I see room down to 290. And there's no reason the 2-year note has to be behind the 2-year Fed funds forward. All right. Then we talk about the 5-year. All right. It's moved from 380 to 348. Below 342, that's April's low. That would be a breakdown. It would be the lowest weekly close since 2022. And I think that's scoped down to 310. Why? 2018 high was 310. Core CPI is 310. Core CPE is 2.8. I mean, the 5-year, you overshoot now too. But not only that, the other thing we started talking about was how all this would be dollar negative. One of the ways it's dollar negative is it puts pressure on the yield differentials. U.S. has had this huge interest rate premium. I mean, at the end of last year, we're talking just 9 months ago, it was 225 basis points. You got paid 2.2% just to hold dollars over euros. That is now shrunk to 135 and made a new low literally this week. All right. The lowest since May of 2023. The dollar index, which is euro weighted too. So keep that in mind. I like to look at everything. That's just $1, measure is the dollar index, USDX. That's the futures contract. 96.37 last. The major breakdown point is less than 100 points away. 96.37 last. 97.73. Check that. 97.73 last. And the June 30th low, which would be the breakdown level, is 96.37. So you're literally 140, 135 points away, which is interesting because the interest rate differential is 135 points. Wow, that's just coincidence, but that's interesting. Dollar right now down 3.5% year over year. Think about gold does when the dollar is down 12, 13, 14, 15%. All right. So the things we said were yield curve. Nailed it. Fed acquiesces to higher general rates of inflation to protect the consumer, housing, and the labor market, maybe even the bond market. It's there. The USDX lower. It's on the verge here. Definitely what's happening, all of this, let alone pushing India towards Russia and China is just not the way to go here, man. That's like the final nail in the coffin of, kind of the dollar pressure, even though it's been going on since 2018. I talk about this all the time. When Shanghai opened, the crude oil futures market denominated in renminbi, and that OPEC agreed to have the Dubai OPEC grade crude be the benchmark, be the crude oil they trade in China in Chinese currency, and Russia benchmarked the Urals crude to it. That was the beginning of the end for the dollar in terms of, being the petrodollar, being the currency of trade, all these things, tariffs, sanctions, double sanctions, double secret probation, whatever, the U.S. does, seize assets. And now pushing India towards Russia and China closer at a time when Russia and China finally agreed on the details to the pipeline they agreed to back when China hosted the Olympics and Putin and China sat down and Xi sat down. The pipeline for natural gas from Russia directly to China and, involving the other countries that are involved in that was amazing. So what's next? Well, what's next? And I told you this too. All right, not to be full of myself, but just so you understand, we've nailed this, and hopefully we're nailing it as we go forward. So, if you listen to kind of the advice we've been giving here, which is specifically, gold and silver mining shares, our top picks, get the special. Here's the macro. Here's the debt. Here's the debt black hole. Here's the whole thing around the consumer cocoon. All this comes down to, things that we said, like people will be chasing the gold market higher. That's happening now. And finally, you're seeing an open interest. This has been BRICS buying. This has been central bank buying in gold. That's why silver hadn't participated until just now. Just now, this is starting to be a rotation of major money from Wall Street, major money management, major pension funds, major, retirement funds, out of the top stocks that are outperform AI, tech, chips. All these things are on the ropes here. And I'll tell you about that in a second. But the degree to which now rotation, we're seeing it in the Newmonts, in the Anglo-Ashantis, and all the stocks, they said, watch these stocks, because when Wall Street moves their money, they're going to buy the names they know. That's how they have to answer to somebody for all of this. So they're going to buy Newmont. And what has happened? Rotation has come in, exactly like I said. It's coming directly out of the tech sector, too. People are chasing this market higher. And right now, the GDX is back to the 2011 high. All right. Honestly, since February of last year, it's up 159%. Over the last 52 weeks, it's up 83%. We've been hawking it for well over 52 weeks. Versus the S&P, over the last 52 weeks, it's up 54% against the S&P, 5,400 basis points. Greater performance than the S&P 500. Against the S&P Infotech, the GDX is outperformed by 4,200 basis points, 42%. 4,200 basis points. Against the Infotech, XLK, has performed the GDX gold mining shares. And versus gold, the GDX mining shares up 27%. 7% against the price of gold. Newmont, I said watch the big three, Anglo Gold, Ashanti, Barrick, and Newmont. The flow turned positive in January 25. We talked about that. Newmont took out 50 in April. We said that was the breakout, the second tier breakout. It's now 76. All right, so 51% in the last 52 weeks. Okay, and it's at a level that it's only been at in 1987 and 2022. And it's up 5% now over 52 weeks against gold. Newmont is up 26% over the last 52 weeks against the S&P 500. And on that ratio spread, Newmont against the S&P 500, it is violated to the upside. Newmont has the downtrend in place since July of 1990, a 35-year downtrend, just like the 30-year bond yield, just like the plot of inflation. All of these things are tied together. And again, we talk about the core PCE rate last at 2.8, hasn't been at or below 2% for 52 months. I mean, wow. I mean, the last time, in fact, that it was at target, we were less than halfway through Biden's presidency. It was 2001. Let's look at some of the stocks that were our top picks, just because, every now and then you got to take a victory lap. And I've gotten so many nice emails lately. So I just want to kind of, maybe just suck some more people in because, we've been doing this a long time. And I think we've really done a good job, and especially when it comes down to our picks. Our number one pick throughout this past year has been Kinross all the way. First in Canadian dollars, then we swapped it into U.S. It's up 165% in the last 52 weeks. Anago Eagle up 98%. Gold Road up 119%. Torex up 113%. Anglo Gold Ashanti up 110. I Am Gold up 106. Goldfields, which we recommended late, not capturing this whole gain, up 158%. In the mining shares, silver miners, okay, with the SAL too. Don't forget the silver. Now it's participating. Why? Because this is a bigger picture move. And the dollar hasn't even cracked yet. Wait till the dollar cracks. Holy mackerel. Fortuna up 88. That's been a big top pick. So is First Majestic, 97. Pan Am always a top pick, up 86% over the last 52 weeks. And MAG up 109% over the last 52 weeks. A late addition to we talked about this too, was Royalty Place and Oceana Gold. It was $6. It's now $26. It's up 700% in the last 52 weeks. We got in very late, but even very late pays triple-digit returns. On the flip side, NVIDIA, the XLK, the XSD, Semiconductor Index ETF all look very toppy. Here's the breakdown pivots. NVIDIA, 168.80. Below that, you have a lot of new money is going to be trapped underwater. XLK, the S&P Infotech, below 255, major breakdown. XSD, Semiconductor ETF, below 267, major breakdown. For the indexes, the S&P 500, 6238, the NASDAQ, 22,775. I think this market is bubblicious. I think it is out of touch, and the bond market is telling the stock market that they're in for a reality check. This feels a lot like, honestly, August into September of 1987. And, in a lot of ways, of course it isn't, a lot of ways. But there are similarities here in the psychology and the interaction between stocks and bonds that feels very, very familiar. I will also add, by the way, the DAX, the German DAX, looks like AI. I mean, the DAX, because of fiscal spending on defense and, unloosening the purse strings, fiscally, has really driven the DAX much like it has driven the NASDAQ. So watch the German DAX too, because 23,440 in the cash German DAX would be a major, major breakdown. And the other thing I would say too, keep an eye on the XLE, the energy sector. Heating oil and crude oil, we're low supplies domestically. We continue to export crude, but we're still a net importer. And, production is high, but we're still seeing inventories decline because we're not pumping out enough distillates or gasoline, to meet demand. So in this case, I think that this is an undervalued area of the market that could work well in a dollar down environment, which would be kind of, that inflationary for commodity sector. To keep up with this, shoot me an email. I have several specials I can send you on the debt, on the metals. Tell me what you're interested in. I'll send you some stuff. Greg Weldon, GregWeldon, Greg Weldon at weldononline.com. All right, we have our most recent gold picks out now after the market's taken off, and people are doing exactly what we said they would do, which is chasing this market higher, which I tried to hopefully got as many of you as possible to understand. You need to be in rather than be the one now that where it's high. Should I buy it? The risk is way, way bigger now. So those are really tough questions. We try and answer those questions every single day. By the way, I like Ethereum here too. I think it looks very well positioned for another big move to the upside. We made a lot of money in the third quarter for our money management clients in Ethereum as well. Follow me on Weldon at Weldon Live, WELDON Live, on Twitter, on X, I should say. Sorry, my screen went blank. That means I've been on for over half an hour. And then Gregory_Weldon at YouTube. And of course, the podcast, Money_podcast. That's it for this week, this month. Thanks for listening. We'll be back at you next time.